The US and China have agreed to a 90-day tariff truce. This has injected a much-needed dose of optimism into the markets. Investors cheered the news, sending the S&P 500 soaring. The truce has eased trade tensions between the two economic giants. This has reduced uncertainty in the global economy. The market rally has been fueled by hopes of a more favorable trade environment. Businesses are breathing a sigh of relief. They had been grappling with the negative impacts of tariffs. The truce provides a window of opportunity for negotiations. It is hoped that a long-term trade deal can be reached. The positive sentiment has spread across various sectors. There is a renewed sense of confidence in the market. Investors are more willing to take on risk. This has led to increased investment in equities. The market rally is a welcome development after a period of volatility. This truce is a significant step towards resolving the trade dispute. It signals a commitment from both sides to find common ground. The positive market reaction reflects the importance of this development. The world is watching closely to see if this truce will lead to a lasting resolution. Goldman Sachs and Yardeni Research are bullish on the S&P 500. They have raised their year-end price targets for the index. Goldman Sachs now sees the S&P 500 reaching 6,100. This is up from their previous target of 5,900. Yardeni Research is even more optimistic. They have set their target at 6,500. This represents an 11% potential gain from current levels. Both firms cite the reduced recession fears as a key factor. The tariff truce has significantly improved the economic outlook. These revised targets reflect the positive sentiment in the market. Investors are more confident about the future. Economic growth prospects have brightened. This makes equities more attractive. The bullish forecasts from these prominent institutions have further fueled the market rally. The upward revisions are a vote of confidence in the US economy. They suggest that the recent market gains are sustainable. Investors are advised to pay attention to these expert opinions. However, it's important to conduct thorough research before making investment decisions. The tariff truce has eased concerns about a recession. Goldman Sachs has lowered its recession probability forecast. It now stands at 35%, down from 45%. This indicates a reduced likelihood of a significant economic downturn. Yardeni Research has also upgraded its GDP growth projections. They now expect the US economy to grow between 1.5% and 2.5% in 2025. This is up from their previous forecast of 0.5% to 1.5%. These improved forecasts are based on several factors. The truce is expected to boost business confidence. This should lead to increased investment and job creation. Additionally, lower tariffs will reduce costs for businesses and consumers. This will stimulate economic activity. The Federal Reserve's accommodative monetary policy is also supporting growth. The reduced recession risks have boosted investor sentiment. Businesses are more likely to invest and expand when the economy is strong. This creates a positive feedback loop that further supports economic growth. The overall outlook for the US economy is now more optimistic. Large-cap tech stocks are leading the market rally. These companies are well positioned to benefit from the improving economic conditions. They have strong balance sheets and are highly profitable. Investors are flocking to these stocks as a safe haven in uncertain times. The AI sector is also performing exceptionally well. Artificial intelligence is rapidly transforming various industries. Companies at the forefront of this revolution are attracting significant investor interest. Goldman Sachs expects AI stocks to continue their upward trajectory. The firm highlights the secular growth potential of AI. They also note that valuations in the sector are still relatively undemanding. This suggests that there is further room for growth. Investors are particularly interested in companies developing cutting-edge AI technologies. The strong performance of tech and AI stocks reflects their importance in the modern economy. These sectors are major drivers of innovation and growth. Their continued success is crucial for the overall health of the market. Investors are closely watching these sectors for signs of continued strength. So, Disney has been showing some really strong performance lately. This, honestly, adds a lot to the overall market optimism. You know, it's not just about one company doing well, it's about what it signifies for the broader market. When a giant like Disney performs strongly, it often boosts confidence across various sectors. And, well, that's something investors definitely take note of, so yeah, Disney's success is a pretty big deal right now. As inflation begins to cool down, market sentiment has taken a positive turn. Investors are feeling more optimistic, hoping that this trend will continue. The easing of inflationary pressures is seen as a sign that the economic environment may be stabilizing, which in turn is boosting confidence across various sectors. However, it's important to exercise caution amidst the growing euphoria. While the current trends are encouraging, there are still potential risks that could derail this positive momentum. It's crucial to remain vigilant and not get carried away by short-term gains, as the market can be unpredictable. Navigating the current market landscape requires a delicate balancing act. Investors need to weigh the positive indicators against the potential risks. It's about finding the right balance between seizing opportunities and mitigating potential downsides. This approach will be key in sustaining long-term growth and stability. Looking ahead, the big question remains: will we see continued growth or face potential headwinds? While the outlook appears promising, it's essential to stay prepared for any challenges that may arise. By staying informed and adaptable, investors can better navigate the uncertainties of the market and position themselves for success. Subscribe to INFORVESTMENT for more real-world investing insights. Stay informed, stay tuned.